Good morning, everybody. Today we're going to go ahead and talk about Green Mountain Coffee Roasters Incorporated. We're going to take a look at the sales return on the 10K for this company in 2010. Without further ado, let us get started. So just as a quick reminder, this is the basic setup of your typical journal entry for a purchase. If the purchase is on an account, it's going to be an accounts receivable. If it is a cash purchase, then that accounts receivable will say cash. It'll be in the cash section. Okay, let's get started. So when something is purchased, let's say someone wants to buy a dress. Now, I'm no artist, but this is going to be a dress. It's not a very good dress, but it's a dress. Let's give it some color. Blue dress. Someone buys a blue dress. Okay, so someone wants to go and buy this blue dress for $1,000. $1,000 because they bought it on credit, and then it's going to go into sales for $8,000. Now, when this happens, you also have to take into consideration the inventory and the cost to make it. For the sake of this illustration, let's say the cost of goods sold was $800, and so now you have to take that 800 out of your inventory as well. So you're going to go ahead and credit your inventory for 800 as well. Okay, so now that your dress has been sold, what happens if that customer decides to come back and return the dress? If the purchaser decides to return the dress because, I don't know, it's an ugly dress, then you have to pretty much reverse what you did in the last slide. So what that entails is you have to take it out of their accounts receivable, and that way they don't owe you any money for the dress that they no longer have. We also have to look at the sales count. That's going to be the biggest difference from the last slide to this slide, is you can't just debit the sales. You actually have to use this account right here called sales, return, and allowances. So what's going to happen is we're going to go ahead and, let's see, debit the sales, return, and allowances for $1,000. And then we also have to, like I said before, take it out of the accounts receivable. So we have to credit this for $1,000. When we do this part here, we also have to look at the inventory and the cost of goods sold. So when we get the dress back, we technically take on our inventory. We get our inventory back. So we go ahead and we debit because we took it out by crediting it. So let's debit this for 800, and our cost of goods sold are going to be credited for 800. Okay, so now let's go back and talk about the sales, return, and allowances. The biggest thing you have to know is that this account is a contra revenue account. It holds a debit balance instead of a credit, and it allows the company to see the amount of the original sale and see the items that reduce the sale to net sales. When we look at this slide, we can see that it's a single line item, and this line item was taken directly from the 10K for fiscal year 2010. Crazy. If we look at the beginning balance, we can see that it is 3,809, and the ending balance is 12,742. So if we look at these, we can tell some quick math or just knowing our accounts that the acquisitions increased the balance, the charges increased the balance, and then the deductions decreased the balance. When looking at these deductions, I am pretty much working under the assumption that they are the returns. Whenever you look at another company's chart of accounts, some may not be the norm or what we would consider normal. So deductions or returns, that's kind of the assumption I'm using for this assignment. T accounts are a great way to visualize the flow of assets, liabilities, or equity from one account to another. So as you can see here, the sales return reserve was increased by acquisitions and the charges to cost and expense. So what happened is both of these accounts were debited, or credited, I mean, and then they had to be debited over here in the sales return reserve to balance the sheet. Now, with that being said, we can go over here and look at the journal entries and see what they would look like. So if you look, you can see that the sales return reserve is debited for the acquisitions right there, and we'll just put an arrow there just for fun. And then it was also debited for the cost, boom, to, or charges to cost and expense. So now that we have all of those pointed out, we're just going to erase all of that and look at the deductions. So the deductions actually reduced the sales return reserve. So what happened was we can see that the sales return reserve was actually credited, which made the account decrease, and then the deductions or returns were increased. So when I put together this assignment, I have been working under the assumption that the deductions, as they were named in the previous slide, are the returns. Now, if you have any questions, comments, concerns, please feel free to reach out and ask, or give me a call or a text or whatever is necessary, and I will do the best I can to answer them for you. Thank you so much for taking the time to listen to this presentation, and I hope you have a great day.